Hello again. It's time for another hike and CPA. So we're here on the Sagatuck Trail. Right here, you can see the marker. And over here is a map of this trail and where it leads. This, in this case, is a network of trails that go around a reservoir. It's a great trail. And because of that, I would suggest going on it. This trail though, I'd rate at a 3.8 or a 4. And that's simply because of how it's marked later on in the trail and how narrow it gets and how there's some switchbacks that are kind of questionable. And at the beginning, you can call me nuts because as you can see, this is a nice wide open flowing trail. It's actually not too bad at the beginning. It's really farther down the trail that it gets a little crazy. So the one thing I also want to point out before we get into where we'll be talking today is this. So right here, this is a road that you're gonna have to actually cross. So there are two ways. One, just hop over the guardrail right here. Let's go ahead. The other way is to walk all the way down here, which is what I'm doing. I feel it's a little safer. And then walk around this guardrail. And over there is where the parking is. So just want to show you that. And so as we kind of go ahead and start this hike now, I just want to introduce that topic for today, and that is tax planning. Year-end tax planning. And this is the best time to do it because you want to make sure you get any deductions you can while you still can. Generally speaking, after the year end, that's it. It's basically done. You can't do too much more. There's a little bit, but not much. And so you want to make sure you go talk to your tax advisor now or listen to some of these tips and see what you can do. And if you have any questions or you want to run anything past somebody, go ahead and let me know. And I'm going to leave my contact information down below. So until then, we'll see you. So this is a network of trails, and it's kind of excited to see that this is a great ledge trail, which is what we did in a previous video when I was talking about the student loan debts and how employers can actually pay the employees and get a tax benefit from it. This also is the Devil's Den, which I probably will go ahead and do a future video on that. Both of these are in Reading, Connecticut, and that's where the Sagatuck Trail network is as well, which goes around a whole reservoir, which is why I kind of think of water when I think of the Sagatuck Trail. So, well, keep hiking and give some more updates, possibly as we go along, until I find a good spot to sit down and chat about those year-end savings. Hey again, so we're here on the trail, and I was able to find some great spots to sit down right here, and with this great view behind us, and right here. So I'm gonna come over here now. I'm gonna sit down. We're gonna have that chat about year-end tax planning. This is something you should definitely do with a tax advisor, as every situation is different, and as you can go and meet with somebody and kind of get to know them and have them get to know you, they can give you some advice specifically for you. In the meantime, here's just some general advice that you can use for tax planning. And again, tax planning is taking this basically, really after Thanksgiving, starting during that time, taking that last month to look at your taxes, see how much you're gonna end up paying in April. You can do estimates. There's not too much tax planning. There's a little tax planning you can do as an employee. There's a ton you can do as a company or as a self-employed individual. And so we're gonna go through a few of those things. And a lot of the stuff for employees also transfers over to self-employed and business individuals. The first thing I want to point out is I'm going to do employees first or individuals first, as that kind of doesn't have too many options. The first option that we're going to talk about is the obvious one: charitable contributions. We all had Giving Tuesday, a week ago now, and so charitable contributions are always something you can do. So even with the most recent tax changes, even if you take the standard deduction, you can actually still get up to $600 in charitable contributions as a deduction. So you take the standard deduction plus charitable contributions. In the past, you could only take the standard deduction, that was it. Now you get up to $600. So go ahead, donate that stuff to Goodwill, as well as any other charitable or 501c3 organization. And if you're not sure, you can actually go to the IRS website, and they have a list of all the 501c3 organizations that you can give to. And for those who go to church or other organizations, keep in mind the one thing you can do, especially for churches, that some people kind of forget, is the tithing, or mostly any money you give to that organization, you can take as a charitable contribution to them. Now I'm going to preface this by saying, if you go for a concert at a church or something like that, and pay for the concert, that's something different. You're not giving a charitable contribution. But if you're going and you're just giving money to the church for their upkeep or for mission trips or for anything else, that is a charitable deduction. You can get a credit for it. The other thing to keep in mind is there are tons of organizations out there that will say they're charitables. Here's another aspect of this. When you give to GoFundMe, that's actually not a charitable organization. That actually doesn't count. Just giving money to a friend in need also is not a charitable deduction. That also doesn't count. Giving it to the Salvation Army is. If you give it to the Salvation Army specifically and say, give this specifically to my friend, that also is not considered a charitable donation, because effectively you're just giving it to a friend. You're just using Salvation Army to do it. So if the charitable deduction has any kind of stipulation with it, it also doesn't count. Basically giving it to the organization and saying, I trust you to do, what you're supposed to do with this. And so that's charitable donations. That's the first one to do, and that's something everyone can do before the end of the year. And remember, all these things, for the most part, are due before December 31st. There are some exceptions, which I'll get to right now, actually. One exception is funding an IRA or a retirement plan. Those things can actually be done before you file your taxes, which is basically April 15th. You need to fund these things before that time, and you can get the deduction. So another aspect is, funding a retirement plan. The most common one are IRAs. You have the Roth IRA, which you don't get any benefit today for. And that's the purpose of the Roth, is that you get zero benefit today, but you don't get taxed on it in the future. And there has its own set of amazing rules that you can follow. And if you follow, you can actually save a ton of money. The other one, though, is the traditional IRA. And you can put into up to $6,000 into a traditional IRA. And that gets offsetted on your taxable income. So it reduces your taxable income today. The thing is, in the future, you pay taxes on it. So that's the IRAs. And that, like I said, you can fund. Another one is funding your 401k. Now, the 401k, the max contribution is $19,500. And that is a pre-tax, so you're not going to get taxed on that, and that comes out of your employee wages. And so it's $19,500. But for those over 50, there's an additional $6,500 you can do. And just as a side note, that $19,500 is going up to $20,000 for 2022. So these numbers do fluctuate with inflation, so you will want to go back and check on what that number is. Another part, and this one is for you self-employed individuals, is a SEP IRA, or a SEP retirement plan. For these can go up to $58,000 in retirement plans. So it's nice. Like I said, it's kind of nice having your own business, because you can do something like this. $58,000 is a lot better than only $6,000 or $19,500 as an employee. But here's the but with that. And like I've said in the past, there's always something there you have to be wary of. In this case, you have to be wary of the fact that it's, the $58,000, which it goes up next year to about $60,000, or 25% of your net income. So if you only made $10,000, you can only do $2,500. So just keep that in mind. There are limitations. With all this, is another aspect you need to keep in mind, especially for those who have older parents or if you're older yourself. The one thing you need to keep in mind is if you're 70 and a half years old or older, with some of these plans, you actually have to have a minimum distribution. So you actually have to take a certain amount out of the plan. Otherwise, you'll be penalized. So it sounds kind of funny, if you're younger than 55, you get penalized for taking the money out too early. If you're older than 70 and a half, you get penalized for not taking the money out at all. So make sure you go check with whoever funds the plan or whoever is holding the plan. Generally, they can calculate this minimum distribution on your behalf. Or, you can reach out to, like I said, a tax advisor, or reach out to me, and I can help you do that calculation to figure out exactly what that minimum is. So make sure you take out the minimum before the end of the year as well. It's another tax planning point. So those tax planning points, there's a few others you can still do. One is make sure you're paying, if you got behind on your mortgage payments or something, make sure you pay those in full. because you can get that mortgage interest. I would say pay your taxes, but a lot of people are actually getting caught up in the minimum $10,000 tax limit that you can get when you itemize your deductions. And so paying property taxes early really today isn't much of a benefit for some. If it does benefit you, then go ahead and do it. Make sure you pay those taxes, today before the end of the year to your town, and you get the benefit of it. And that's great if you're able to itemize. And there are a lot of other itemized deductions you can do as well that can help you reduce it. They really, like I said, as an employee, they really aren't that much more. Those are kind of the big ones: charitable contributions and kind of mortgage interest, and as well as gambling losses. If you're a gambler, you have to pick up all your gambling winnings. So make sure you know what your gambling losses are for the year, because you can offset those against your winnings. And a lot of times that usually nets out to negative. For some, if you're lucky, your nets out to positive, and you're going to be paying taxes on it. But make sure you keep track of all this stuff. That's the last reminder I want everyone to remember, is with all these things, keep track of them. If you donate to Goodwill, they usually have a little placard they give you. Keep track of that. Put that somewhere safe. If you donate to anywhere else, they have a receipt they give you. Keep that safe. Because what you want to do is, when it comes tax time, you want to give that to your tax advisor, but you want to look at it. The reason for this is IRS will ask for this in an audit. I actually have a friend that they got caught up on this because they didn't have everything, and they ended up, getting their deduction reduced because of that and paying a little more taxes. So keep track of these things. And if you want to do the ideal, what is ideal is actually taking pictures. For example, Goodwill, if you're donating clothes, take pictures of clothes you donated. So that way, if anybody asks, you're like, yeah, I donated this bag of clothes. On top of that, this is what was in the bag. And that is the ideal, if you can do that. Most people don't. But if you can do that, under audit, ideal, especially if you're moving. I know this past year has been tons of moves out there. And so if you're moving, that is extremely ideal, because, you're giving down in the Goodwill in Virginia. And now you're moving up to New York or Connecticut. And, it's going to be hard, and you're giving a ton because you just moved. And so it's really beneficial for that purpose. And gifts. You can give gifts. You can give up to $15,000 to any individual. If you're married filing joint, that kind of doubles that to $30,000. And this is something some people do to help contribute to their kids. They give $30,000 a year to the kids, and this is tax-free. You don't pay taxes on it, and neither does the child who receives it, or whoever you're giving it to. No one pays taxes on it. You don't take it as a deduction, but no one's paying taxes on it. So it's a way of transferring wealth with a lower threshold. And with all the identity theft out there, you can actually get a special PIN that you file with your taxes. If you ever had identity theft on you, or if you had to reach out to IRS, let them know, you already have one of these. But it's something they've opened up to everyone. You can go on their IRS and get a special PIN to show them that it is you who is filing, and that's not a fraud. And that's something else to keep in mind for this here. There's something new you can do. You've always had to add a PIN, but this is something specifically sent to you from the IRS stating, here's the, this is me. So that way they can verify who it is. Here's some ideas that I don't totally like, but they are out there. So if you have a lot of losses from selling stocks or anything else, you can actually take those as a loss up to $3,000 in the current year from your taxes. And so that's one thing some people like to do if they are having a bigger year than they anticipated. They'll sell some losses at the end of the year to help kind of offset some of those increases that they had that they weren't expecting. And so that's another part that you can do. And another aspect is energy efficiencies. So if you put solar panels on your roof this year, or if you got certain boiler systems or new heater system put in, go check. You might be able to get a rebate on these things on your taxes. Or another obvious one that a lot of people have kind of been hearing about is the electric vehicles. With these, there's actually a credit you can get on your taxes when you buy them. And so this is something to keep in mind as well for tax planning. Maybe you want to go buy an electric vehicle and you're having high taxes. Right now it might be a good time to go buy one to help reduce your taxes. So it's something else to keep in mind. And then use that as a segue into business as well. For business, if you're thinking about buying a vehicle or an asset, a desk, a truck, a new building, anything, well, maybe not a new building. This doesn't apply for that. But for anything else, maybe making some improvements on your current building, these can actually be depreciated. A lot of them can be depreciated today. And so you get additional expenses to help reduce your taxable income this year. And that's something you can do for a business. You can consider. Another part is paying out more bonuses, paying out employees a little more, give them a very Merry Christmas or Happy Holidays, and paying them out a little more. That will help reduce it. Another one is if you have a retirement plan that is a profit sharing plan, fund that. And that will also help reduce your taxes. And if you have any kind of expenses that are still out there, you can record them or pay, if you're on cash basis, pay them off. That again reduces your taxes. And if you notice, so there are a lot of different avenues and areas you can do this with for business. So keep that in mind. With business, you can take a lot of these deductions. So that, again, those are some of the year-end tax planning ideas and tips that you want to look into. And you want to go reach out to your tax advisor. The last tip I want to make sure you know is keep track of everything, all your documents. You're going to start receiving them in the next couple of months. Keep track of everything. If you're not sure, just put it in the pile and keep track of that pile. So when it comes February, mid-February, and you have all your documents, go ahead and bring them to your tax advisor and say, hey, here it is. Here's everything. I know we chatted about tax planning. I ended up doing it or I did not do it. Whether or not you received the advanced child tax credit, that I should be sending you a little notice saying how much you received. Keep that in hand, saying, yes, I received this, I did not receive it. Any other kind of rebates or anything you received from the government, keep those in hand, saying I did or did not receive it. So that way, it's going to help expedite your taxes and stop a lot of the back and forth, that you kind of receive, or a lot of people receive every year as we are trying to figure things out. That is another great thing about this tax planning, is that you let your tax advisor know or ahead of time kind of what to expect. And so when the time comes, they're not surprised by a sudden gain. For example, I've had this happen before to me, where we received a sudden gain of $250,000 from a K1 that no one was expecting. It just popped. I'm like, great, this just messed up all our planning. Now the person owes a ton of taxes because we did not know that ahead of time. So if there's any way to find that information out, go find it out, and that'll help with tax planning as well. And there are a lot of other areas and avenues with this too. One last thing before we end this. So for all those who work from home, you are technically telecommuting. And so you want to keep track of what office you're actually telecommuting into. And that's going to change the taxes that you'll be paying as well. I know a lot of people in the area that I live telecommute into New York. And New York says, okay, you're basically working in New York, during this time. Because yes, you're working from home, but really, your office is New York. And so just be wary of that. Be careful of this. I know, for example, somebody else, we had another client that they moved out to Rhode Island. And they originally worked in New York, moved out to Rhode Island. Their office moved to New Jersey, but they're still paying New York taxes. There's no connection to New York. There's no reason why they should have been paying New York taxes. In fact, they should be paying New Jersey taxes and Rhode Island taxes because that's where they moved to. And so that's one thing to keep in mind. Where are you telecommuting? Where's your workstation? Where are you supposed to be working? And that will influence, these taxes as well. Today, with amazing technology, you could theoretically be working out of an office in Miami, Florida, when you're living up in Maine. And so with that, you're not going to be paying any state taxes except for to Maine because there's no state income tax in Florida. So these are some of the benefits of telecommuting as well. But just kind of be careful of this. Make sure you know which office you're telecommuting into because that will influence your taxes and if you're going to be considered as if you earn the money there in the other state. Like New York, for example, says you totally earned it here. We want our taxes. So keep that in mind as you're doing this year-end planning as well. And, good luck with your year-end planning. If you have any questions, go ahead and respond back to me and I will try answering them. Again, you might need some clarification as every situation is different. I'll go talk to your tax advisor and do this year-end planning now that you have some ideas of what can happen. And, do the best you can to reduce those taxes to the minimum you can. So until next time, happy trails.